To get us across all we need to know about the day to come and the week that was, Josh Barker from Barker Wealth joins me now. Josh, nice to see you.
Good to be here.
I'm not going to talk about the week that was yet, because obviously we've got today to get through. We're expecting a bit of a drop at the open. Is that just largely because of the absence of a US lead?
Yeah, look, I think the US has been rebounding quite well over this week. I sort of came on earlier this week and just hoped that the market would stay flat. And the US market has done a little bit more than that. So good to see. But I guess there's a couple little concerns coming through for the ASX. Tightening of some lending restrictions. Obviously the inflation, now we're talking about interest rates potentially going higher in 2026, when we were really anticipating 1 or 2 cuts in the next 3 months. So yeah, that's completely reversed, which is, I don't think I'm reading into it too much yet. We'll get the interest rate changes when they come. The RBA is, always slow to react both ways. So I'm not too concerned about an interest rate rise at this stage. But I think it's just a slight change in sentiment that's restricting the ASX from bouncing as much as what the US has. But hopefully that goes away and we go back to highs almost like the US has done, or hopefully will soon.
Yeah, okay. So when you are talking about not being concerned right now about whatever direction interest rates ultimately go in, is that because you're really focused on business fundamentals right now?
Well,
I mean, as always, but I mean, is now a particularly good time for active management?
Yeah, I think everything else is doing well, apart from, I guess, that slight tick up in inflation, which is obviously a concern, but we've still got a constrained jobs market. Everyone's employed, everyone's spending. We had the retailers report a little bit this week and seemingly doing well, Black Friday. So it's not dire for the consumer, and that's obviously a lot of the Australian businesses are servicing that. So I think corporates are still going to make good margins. The costs are controlled like we've seen over the last couple of years. So I wouldn't expect there's too much hiccups to come on a fundamental level for many companies anyway.
So strategically, Josh, because we're entering this normally seasonally strong period for equity markets, how are you positioning client portfolios?
Yeah, so we've had a bit of a pullback in the market, obviously, from those highs, which is it's been rare over the last 6 to 12 months that we've had a pullback and a buying opportunity where the broader market is down. So I think that's probably an easy way to play this. We're sort of buying the broader market through an ETF called GEAR, GEAR. And what it does is it simply, it's leveraged exposure to the ASX 200. It's a little bit different from most other leveraged ETFs in the fact that most of them use futures, whereas this actually buys the top 200, takes out a loan and buys more of the top 200. So what that means is you actually get a yield from it, like a genuine yield coming from the companies. It also means that those companies are passing on the franking credits to the fund, and then that's passing through to the investors. So the yield's been quite low lately, but historically in the past it's sometimes been between a 5 and 10% yield when interest rates were really low and the market was running quite hot. So it was one that was used quite a fair bit then, but the last couple of years it's obviously with interest rates being higher, and we're sort of talking the last 12 months where interest rates have been, it's had somewhat of a subdued yield, so about 1.5%. But that comes with about 300% franking credit. So it's because obviously it's just paying down the loan with that cash, and all the franking credit is getting passed on. So it's a little bit different to most other leverage plays on the market. It really is like a genuine play of buying the companies and benefiting from that yield. So I think it's a good time. The markets have pulled back. We're going into the Christmas rally, which is typically like a broad market rally, so you're getting that clean exposure. If you go and buy an individual company, it doesn't necessarily mean that's going to be the one that ticks higher throughout that period. Usually it's often the big names that have a lack of selling pressure anyway, with a lot of the fundies being on holidays. So and then also you've got January 1st, it's going to pay its distribution, which is for the last 6 months. So it's a pretty good time to take up an allocation in it. We usually play it on a smaller time frame, so probably 3 to 9 months. But again, you've got that assurity that it's just the top 200 companies with that loan in it.
That's an interesting one, isn't it? Would you use this as a core holding? Do you have to be careful as an investor that you don't become overexposed to potentially some of those top names?
Yeah, of course. And it does, I guess, factor in because it's got a heavy weighting in financials and materials, as you can imagine. So it does always depend on your portfolio. But it's one that we'd probably treat as, more of a short-term play. Longer term, obviously that margin loan can work as a drag on the market, especially if the market's sideways for a prolonged period of time is when it's underperformed. But if you get it in a time where the market's going up, obviously it's doing twice what the market does, plus you're getting that yield on top.
So if we have a US interest rate cut, which is what's fueling sentiment right now, and we head towards Christmas, what you're saying is you're looking for that Santa Claus rally, so to speak.
Yeah, I think that broader pullback is just going to tick a lot of the big names higher. The pullback's been from AI valuations, which shouldn't impact many of the businesses that are in this. I don't think it impacts Wesfarmers at all. So those are the sort of names that are just going to gradually tick higher over that Christmas period.